Good afternoon, everyone. So today we are going to learn a new topic titled Acquisition Expenses in Business Combination. So you can see that we have something we learned in previous courses like Principles of Accounting 2 or Intermediate Accounting. We learned something about this topic already. But in the Advanced Accounting, we are going to learn something new. That means whatever you learned before, you have to forget it. And from today, as we are solving the advanced accounting, you have to remember the new rules. So what we learned before? Before we learned that, here you can see the acquisition expenses. Acquisition expenses are capitalized with the investment account. So this is what we learned before. Acquisition expenses are capitalized. But what we are going to learn now, we are going to learn now acquisition expenses are recorded as expense acquisition expenses, okay, whether these expenses anyway, acquisition expenses are recorded as expense separately. That means we are not going to capitalize. So look at the example. The example will give you a clear idea. This is the example. So ABC company acquires 100% of net asset of XYZ company for $120,000. So you buy parent company. So here we know that this is the parent company. Parent company is going to acquire 100% of subsidiary company. Subsidiary company, okay, for $120,000 and paid cash $120,000. So you buy 100% of subsidiary and you pay cash 100. And someone help you to buy this another company, and you have to pay them the professional fees expense 6,500. Do you understand what is the meaning of professional fees expense? Some accounting firm maybe, or some brokerage firm helps you to buy this company, right? And as someone help you to buy this company, you pay them 6,500 in addition, right? In addition. So what we did before we record investment in S company, S means subsidiary company, investment in S company debit, and we record cash credit. And to do so we calculate something like this. 120,000 is the investment, right? Because you paid $120,000 for this investment, and in addition you pay 6,500 as a brokerage fees or as a professional fees. You know that what is the meaning of brokerage fees, right? Some companies, brokerage firms help you to buy this company. So we add this together. We add these two items together, okay, and we record debit, and it is this is debit. This is debit, And you record cash credit. You record cash credit. So it means that you can see that here $6,500 is going to capitalize, right? Is going to capitalize. Is going to capitalize with the investment account. Do you understand? So this is the previous rule. This is the previous rule. Now what is the new rules? So acquisition expenses are recorded as expenses separately. So according to the new rule, this is the journal entry. This is the journal entry for investment. Okay, this is the journal entry for investment, and we record professional fees expense, debit, and cash credit. It is 6,500. So now we have two journal entries separately. Okay, we have two journal entries separately. Do you understand here? So we have more examples, don't worry. So this is the new things. Acquisition expenses. That means whether if we have any direct or indirect acquisition expense, we have to record them as expense. Clear? So this one is the direct. This one is the direct example. So when you acquire something, not something, if you acquire another company, the direct expenses are called the professional fixed expense. So we have another example I can show you, indirect one. So this example is about direct, right? We have another one, maybe something like merger department expense. Merger department expense. It is called indirect. Indirect. And if you have these things, you have to put the money here. So these two examples, this is about direct expense for the acquisition. Direct expense for acquisition. This is the indirect expense. This is the indirect expense for acquisition. And the example is professional fees expense or brokerage fees expense. And this is the department, merger department expense is indirect. So this is the first one. So according to new rule, you can see that according to new rule, direct acquisition cost and indirect acquisition cost are recorded as expense, right? Look at another one, the cost of issuing securities. The cost of issuing securities, this is another important items you will find out in the advanced accounting later on. So another cost is called the cost of issuing securities are also excluded from the investment account. Consideration means investment account. So here we excluded professional fees expense. Look, we excluded professional fees expense. We excluded, yes. So we excluded professional fees expense. We excluded indirect expense. Then in our question, if we have something acquisition cost for issuing securities, we also have to exclude it. And what is the journal? Then we have another things called additional paid in capital. Yes, so additional paid in capital, you know that. Additional paid in capital, if you remember your principles of accounting 2 or advanced accounting, additional paid in capital sometimes debit, sometimes credit. Can you remember? Right? When it is debit, if you have some loss or if you have some additional expense. Okay, so if you have some loss, okay, or expense, that means this is cost of issuing stock, something like this. Cost of issuing a stock. So when you issue a stock, okay, then if you have some additional cost, then we are going to record additional paid in capital, debit side. And if you have a gain, then additional paid in capital credit. Can you remember this? So additional paid in capital sometimes debit, additional paid in capital sometimes credit. This example, additional paid in capital is debit because you are going to pay some more money when you buy another companies by issuing your stock. So this is the new rules, how to create acquisition expenses. Do you understand? Acquisition expenses, we may have some direct expense, may have some indirect expense. We have to record them expenses separately, not capitalized. Okay, I repeat here again, not capitalized. This is the new rule. This is the new rule. So, however, if we have any cost of issuing securities, okay, if we have anything about cost of issuing securities, then we have to exclude it. The cost of issuing securities, make it clear. If we have any cost of issuing securities, so as it is cost, right? As it is cost, so additional paid in capital debit and cash credit. Now, considering this theory, we are going to solve one question. We are going to solve one question. Acquisition cost illustration. So suppose that SMC Corporation acquires 100% of the net assets of B company. The net book value is $100,000. So the book value of B company, again, B company means subsidiary company and SMC company is the parent company. So whenever you will read the question, please make sure who is the parent company and who is the subsidiary company. This is important. The question may not tell you directly which one is subsidiary and which one is parent. It is your responsibility to find out. I repeat again here, it is parent company. And B company is a subsidiary company. So subsidiaries company's book value, you can see that subsidiaries company's book value is $100,000. Okay. And we are going to acquire them 100%. Okay. We are going to acquire them 100%, but we are not going to pay any cash. We are going to issue them our common stock by issuing our common stock. What is the meaning of our common stock? Means parents company's common stock, right? You are the parents company, you want to buy a subsidiary company, and what is the book value of subsidiary company? The book value of subsidiary company is $100,000. Now you are not going to pay cash, you are going to give them your common stock. Okay, and your common stock market price, is $120,000. That means you are going to pay them more, right? You are going to pay, book value is $100,000, but the issue you share you sacrifice, their value is 120. With respect to the merger, SMC incurred 1,500 accounting and consulting cost. That means the professional fees or brokerage fees, okay, is $1,500. $1,500, and you pay $3,000 for a stock issuance cost. Do you understand, right? So professional fees $1,500, cost of issuing capital $3,000, and SMC maintains a merger department. Okay, they have a merger department. They are looking for different company to buy or not. Okay, so the merger department incurred $2,000 cost. $2,000 cost. Now prepare the journal entry to record. So previously, you remember that previously when we record this journal entry, we add all the things together, right? 120 plus 3,000 plus 1,500 plus 2,000 all together. Now we have to record separately. So what should be the first journal? Yes, so if we, although the question did not tell you to do the first one, question told you to record only direct and indirect, right? The question only tell you to record direct and indirect cost, but I can show you the investment journal also. Okay, so this one is not given by the question, but I can show you. So investment in S company debit. So your investment is $120,000 here, $120,000, and no, so you are going to buy $100,000 investment, right? You are going to buy $100,000 investment, but you are going to issue common stock. You are going to issue common stock. Issue common stock is 120, right? So this is the common stock you issued, and the investment in S company. Okay, that means the asset, net asset, right? Net asset is $100,000. $100,000. Now you know that based on your previous course, previous chapters, you know that what is the difference here? Difference is the goodwill, right? Difference is the goodwill. So $20,000 is the goodwill here. So this is the journal for the investment account. But actually, this question asks you to do this one. Prepare journal entry to record direct and indirect cost. Okay, so professional and consulting fees, this one is direct cost. This is the direct cost. Then $3,000 already mentioned clearly. This is issue a stock, cost of issuing a stock, right? Cost of issuing a stock. And they have a merger department. They also incurred some cost. So this is not direct. This is their indirect cost. So when it is a direct cost, if any brokerage firms help you to buy another company and you pay them the money, this is the cost related with market. Do you understand? Brokerage cost belongs to the market, but merger and department cost, it is inside your company. So whenever you have the cost inside in your company, it is indirect. Okay, but when you go to the market to buy another company, some brokerage firms help you to buy this, you pay them cost, and this is the direct cost. So I think you understand what is the difference between direct and indirect. Now I can copy this from here. So professional fees expense debit, and it is $1,500. Then we have merger and department cost. This one is 2,000. And we have cost of issuing capital, it is 3,000. Or in the exam, if you want to write something like this, this is or alternative, or you can follow the following journals. I mean, all the journals together. Do you understand? Either you can write three individually or you can combine this all together. Any question? Okay, so you understand the basic concept about how to report acquisition expenses according to the new rules, right? Now let's see the acquisition accounting, the valuation of accrued asset and liabilities. Okay, we can do it by solving one question, that the Peterson company is the parent company. So in the exam question, I also try to write a company, parent company start with P, okay, and subsidiary company start with S, so that you can easily differentiate, okay. So I will try to do that. So parents company start with P and subsidiary company start with S. Subsidiary company. So parent company acquired assets, and please read the question carefully. This question said that you buy their asset, okay, but accept cash. Accept cash. And you also buy their liabilities. So you buy all assets except cash, then you buy their liabilities, and immediately prior to the acquisition, the subsidiary company's balance sheet was as follows. So this is the balance sheet for which company? This is the balance sheet for subsidiary company. So this is the balance sheet for subsidiary company. Subsidiary company's balance sheet. Now we find that here we have book value of cash and fair market value of cash. So this is, we have to ignore. We have to ignore this cash. Why? Because our question said that we are not going to buy their cash, right? We are not going to buy their cash. So this account is totally going to ignore from this question. So what we buy? Actually, we buy their receivables, fair market value, right? Then we buy their inventory, we buy their plant and equipment, and we buy their land, right? So these are the items we are going to buy from them. Yes, we buy their receivables, inventories, and we buy their plant and equipment and land. And we also buy their liabilities. We also buy their liabilities. So these are the things we buy here. Now there is any goodwill, because we cannot say that whether there is any goodwill or not, because we don't know how much money we paid for that. Okay. So at this moment, we cannot say we have goodwill or not. So at this moment, we just know this. We buy their asset, except cash, and we buy their liabilities. Now, you know that if we want to know the goodwill, have available or not, we have to calculate the net asset, right? We should know the net asset and we should know how much cash we paid. Otherwise, we cannot determine whether we have any goodwill or not. So here, fair market value, and you should be except fair market value of assets, and you should be except cash. So what is the amount here? Fair market value of asset except cash. So this is the total fair market value, right? This is the total fair market value is $1,944,000 and minus the cash, right? Except cash. This one minus this one equal, we are going to get the fair market value of asset except cash, and it is $1,824,000. So this is the fair market value of asset except cash. Do you understand how to do that? Right? You understand? So this is the fair market value of asset except cash. So we know the fair market value of asset. Then we know this is the fair market value of their liability. Fair market value of asset, fair value of liability, right? No, not this one liability, sorry. Not this one liability. This one is the liability. So we know fair market value of asset, we know fair market value of liability, we can easily calculate net asset. Then we need how much money we paid. Now look at the question here. The parent, prepare the journal entry. We are going to record the journal entry of the parent company. We are going to record the journal entry on the parent company, purchase assets and the liabilities of S company, and the amount was paid. Okay, look at here. The amount was paid is $1.560,000. So we know this information. We know fair value of asset without cash is this amount. Okay, fair value of asset without cash is this amount. We know what is the fair value of liabilities. This is the fair value of liabilities. This is the fair value of liabilities. And as we know this, we can easily calculate. What is the amount of net assets. So the net asset is $1.560,000. So we know this is the net asset, and you also know the formula, asset minus liability. And how much cash we paid according to this question? We paid cash this amount. No, net asset is not this one. Yeah, net asset is 1.230,000, right? Yeah, so this is the net assets. The net assets, and we paid more. The remaining is the goodwill. So this is the goodwill. And the question asks you to record these journal entries. Okay, so how to record the journal entry? We buy their asset except cash, right? We buy their asset. We buy their asset except cash, and we find that we have a goodwill. We have a goodwill. And actually we buy their fair market value. We buy all of their asset based on their fair market value. So this is debit. And we find that we have a goodwill debit, goodwill debit. Then we buy their liabilities. We buy their liabilities is this amount. And we pay cash. So we buy their asset, we buy their liability, and we pay cash, and the difference is the goodwill. Difference is the goodwill. So this is the journal entry. Now we can see another topic is called the bargain purchase. Bargain purchase. What is the difference between a goodwill method and a bargain purchase? So look at this table here first. Look at this table. So this table said that the net asset value is how much? It is $1,230,000. But how much cash we paid? Compare these two items. So here net asset value is lower, right? But our cash payment is higher. So if this is the case, then we are going to record goodwill, right? We are going to record goodwill. If the situation is opposite, what is the meaning of opposite? That means net asset value is higher, but you pay cash is lower. Okay. So if this is the case, so this is called fair market value is higher, is lower, and we paid cash is higher. We paid cash is higher, so we have a goodwill. So this scenario is opposite for the bargain purchase. So let me show you the explanation first. So here we find that same examples. For example, we are not going to pay this amount, so we are going to pay this money. So here we find that fair market value is higher. I just changed the number. Fair market value is higher, and we paid cash is lower. So try to compare these two again. Fair market value is $1,230,000, but we pay cash only $990,000, right? If this is the case, this is called bargain purchase gain. So this is good news or bad news according to this example? Good news. So good news means gain, right? So we can say it bargain purchase gain. So bargain purchase gain is how much here? It is $240,000. Now, if you understand this table, now let's see what is the meaning of bargain purchase option. You can see that when price paid to acquire another firm is lower than, that means you paid lower amount, right? Do you understand? You paid lower than their fair market value. Like here, we paid lower than their fair market value, right? Then it is called bargain. So this is the definition of bargain. That means if you paid lower than the fair market value, it is called bargain. Now look at here, there is no goodwill here. Do you have any goodwill here according to this example? No, right? So we should not have any no goodwill. So no new goodwill should be recorded. This is another things. You cannot record any goodwill here. Okay, you cannot record any goodwill because there is no goodwill. And instead of goodwill, we are going to record which account? Instead of goodwill, we are going to record gain, right? Gain. And gain is debit or credit? The normal balance of gain, it is debit or credit? So before we record, look at here, before we record goodwill debit. Now we do not have any goodwill, right? We have to record gain, bargain purchase gain. And gain normal balance is debit or credit? Credit, yes. So we are going to record it in the credit side. So I think you understand this calculation, right? You understand this calculation. Yes, sir. Another question said that we are going to repeat requirement A. Okay. We are going to repeat requirement A. This is the information about requirement A, right? This is the information about requirement A. We are going to repeat this, assuming that we paid $990,000, right? And this is the calculation. And if this is the calculation, we can do the journal entry. And I can show the journal entry here. So we buy their asset, right? We buy their inventory, sorry, we buy their receivables, we buy their inventory, we buy their plant asset, we buy their land, and we are not going to record any goodwill. Because if there is a bargain purchase option, I told you here, if there is any bargain option here, we should not have any goodwill, right? So I deleted the goodwill. I buy the liabilities, right? And how much cash I paid? I paid $990,000 cash. This is the cash paid. This is the cash paid. So I buy their asset, I buy their liabilities, but interestingly, I pay lower amount of cash than their net asset. So the remaining is called gain on acquisition. The remaining is gain on acquisition, and this is $240,000. So look, before we record goodwill, because why we record goodwill? Because we pay them more money, and we pay them more money because of their goodwill, right? They said that we have goodwill. Okay, we are going to pay you more money, and we buy your goodwill. So we buy their goodwill and we pay more money. But another question said that we are not going to buy their goodwill. We are going to pay them less money than their market price, and it is our gain. It is our gain. Okay. Then let's see another question from another textbook. So this is a problem from another textbook. Let me explain. So Proust Corporation is a parent company. Is considering a merger with civil company, okay, subsidiary. So we know a parent company is going to acquire a subsidiary company. Nothing is new here. After considerable negotiations, the two companies determined that two shares of subsidiary company, look at here, two shares of subsidiaries companies would be replaced one company of one stock, one shares of parent company. So what is the meaning? Meaning is 2 shares of S company equal 1 share of P company. This is the meaning here. That means parent, they have a negotiation. They have negotiation that yes, I am going to acquire your company. I am going to buy your company, but I am not going to pay you cash. Okay, I am not going to pay you cash. I am going to give you my stock. That means I get 2 stock from you. Okay, for example, I get 2 stock from you and I give you 1 stock, and your company becomes to my company. So without paying cash, the parent company is going to issue the common stock. And how they handle this? They handle this that they are going to receive 2 shares from subsidiary company, right? They are going to receive 2 shares from subsidiary company, and they are going to pay actually 1 share of their parent company. Clear? So the balance sheet of 2 companies are below. Again, you should know which one is parent and which one is subsidiary, because the question give you both companies information. Okay, the balance sheet of 2 companies are given below along with their fair value of subsidiary company. So as we are going to buy subsidiary company, we should know their fair market value, right? So we don't need what is our fair market value? We don't need this information. We need the fair market value that we are going to buy. So we are going to buy subsidiary company, and this is the fair market value of their asset. This is the fair market value of their liability. Okay. And at this time, that means at the time of acquisition, the parent company's stock market price is 50 shares. So parent company's share price at the market is $50. And at this moment, at the time of acquisition, subsidiary company's market price is $25 per share. So this is the market price. This is the fair market value of their asset, and this is the fair market value of the asset of parent company. Now, according to this question, both companies' par value is $10. What is the meaning? The meaning here is, for example, this $50,000. Okay, how to define this $50,000? So $10, I can say $10 plus $40. Do you understand up to here? So market price is $50, right? But $10 is the par value, and $40 is the additional value. You know that additional means additional paid in capital, right? Additional means additional paid in capital. Can you remember this? Okay, so that means you are going to give them 1 share, right? You are going to give them 1 share, and this 1 share, $10 is the common stock, and $40 is the additional paid in capital. Clear? Is the additional paid in capital. Okay. And this is the question. I think you understand the question, right? You understand the question, because we have to record common stock and additional paid in capital separately. Do you understand? And I told you that some textbook use other contributed capital, some textbook use additional paid in capital. So if you read several textbooks, don't be confused. This is the same. Other contributed capital or additional paid in capital is the similar term, but used by different textbook, by different company. So what is the required? What is the going to solve? So assume that the merger will be accounted for an acquisition. Okay, anyway, so that means you are going to buy, and determine the value of the stock issued and resulting the cost of the mergers. Okay, so we are going to determine, okay, how many stock we are going to issue. Okay, we are going to determine how many stocks we have to give them. Very simple. If you have 2 shares, you give it to me, I am going to give you 1 shares, right? So we have to calculate. This is the, look at here, this is the dollar amount, right? This is the dollar amount of subsidiary company's common stock. Try to understand. This is the dollar amount of subsidiary company's common stock, and this is the par value of the subsidiary company and par value of parent company. Same, their par value is same. So can you tell me, according to this information, how many shares are available for subsidiary? This is the dollar amount. Look at here. This is the dollar amount. Okay, so I can show you some calculation first here. Subsidiary. Subsidiaries companies common stock. Okay. Common stock is $75,000. Right? Subsidiaries companies common stock is $75,000, and par value share is $10. So this is given in the question, right? This is given in the question. Subsidiaries companies common stock $75,000, right? And their par value is $10. Based on this question, can you tell me how many shares they have actually? How many shares they have? 7,500. Very good. So 7,500 shares they have, right? These are the shares they have. Yes. Now, subsidiary parent company said that. So parent's company. Parents company said that this is the share I am going to receive from you, right? This is the shares I am going to receive from you. But how many shares I am going to give it to you? You give me 7,500 shares, right? Because I am going to acquire your company. I am going to buy your company. So I am going to get 7,500 shares from you. But I am not going to give you any cash. I am going to give you my stock. How many stock I will give it to you? Half, right? Very good. That means divide by 2, right? So this is 3,000 something, right? Yes. Let me see. Yes, so this is 3,750, right? 3,750. So 3,750 shares I am going to sacrifice, right? Parent company is going to give you these shares. Then for how much? For 50, right? For 50. But yeah, this is the 50. So equal, it is 18750. 187,500. Yes. I think you understand up to here, right? Now this is the total stock, right? And because balance sheet tell us that we have to record it separately, right? We have to record separately. We have to record common stock and we have to record additional paid in capital. And I already told you that this $50,000 we are going to sacrifice, right? $10 is for common stock par value and $40 is for additional, right? Now this calculation we are going to do something like this way. $10 for common stock. And $40 for additional paid in capital. I think you understand, right? So this is the calculation. How the parent companies issue their stock. They buy 3,750 shares, paid $50 is the market price, and we divide these two groups. Why we need to divide these two? Because our question give us this. Question said that $10 is the par value. So par value goes to the common stock and additional goes to the additional paid in capital. And determine any goodwill. So do you have any goodwill or not? If yes, we have to determine and record. So yes, we have goodwill because look at here, how much we pay, how much our sacrifice. This is the amount we sacrifice, right? We sacrifice $185,000 and 500 shares, right? But what is their book value? So we have to know how to calculate the book value. How to calculate the net asset. Sorry, what is the net asset? So this is the fair market value of asset. This is the fair market value of liability. Difference is the net asset. So we are going to see we have goodwill or not. So this is the fair market value of their asset. So total fair market value. So according to this question, you can see that they also buy their cash, right? They also buy their cash. But can you remember the previous question? Previous question said that they did not buy their cash. So please read the question carefully. So this question says that they buy their cash, they buy their receivables, they buy their inventory, they buy their equipment, and this is the total fair market value of the asset, and this is the fair market value of liabilities. This is the fair market value of liabilities, and net asset is $152,000. So you are going to buy $152,000 value of company, but you are going to sacrifice 187 and 500 shares, right? A value of shares, dollar amount of shares. So we have a goodwill, right? We have a goodwill. So this is the net asset we are going to buy. This is the money we are going to sacrifice, not money, I mean a stock. We are going to sacrifice, and the difference is 35,500. Is the goodwill. So we find that yes, the question said that is there any goodwill, if any, right? We find that yes, we have a goodwill. We have a goodwill. Now we have to record journal entry. Very simple. We buy their cash, we buy their receivable and plant asset. It is debit. It is debit. We know that we have a goodwill. Debit. And this is the amount. We buy goodwill, debit, right? Then we also buy their liabilities. We also buy their liabilities, and how much is the liabilities? $10,000. $10,000. Now you know that here we paid total capital. We sacrificed total capital 187,500, but par value is something like $37,000. 37,500, right? And additional paid in capital is about $150,000. Do you understand this? So this is our sacrifice, right? But this is the total sacrifice. But we have to make it separate. Some for par value, some for additional, right? Some for par value or some for additional. So common stock credit. And if you remember your principles of accounting to common stock, always follow par value. Okay, common stock always follow par value, and it is $10. So $10 times how many shares we are going to sacrifice? 3,750. Yes. These are the shares we are sacrifice, and we pay them . And remaining is the additional paid in capital. Remaining is additional patent capital. This is $150,000. 150. So this is the calculation and this is the recording. Do you have any question? No question?